how will you repay that loan? Monthly debt. We want to know what are you carrying each month as far as any credit cards, any car payments, student loan debt. We want to calculate all of that into your mortgage payment when we qualify you. Your monthly income and your employment. How long have you been on your job? We usually look for 2 years or more of employment on the same job, or if you change jobs, as long as you're in the same industry, we want to see some consistency there. And we're also looking at monthly income. What are we bringing in a month? That's going to help us qualify for that mortgage. We're also looking at your assets. How much do you have saved, and how much are you looking to put down? So that can kind of help us as far as what type of programs we're going to put you into. Collateral. What are you purchasing? So we want to take a look at the home that you're purchasing. What's going to be the appraised value? And the down payment comes into play there also, because we're looking at how much you're putting down on the property that you're looking to purchase. And credit score, which is a big factor when getting your mortgage. We generally look for credit scores to be over 620. But the lower the score is, can affect your interest rate. The higher your score is, can give you a better interest rate, and also can give you better PMI premiums, which we're going to touch on too, which is called private mortgage insurance. So mortgage language or jargons you may hear when you actually start starting to get into the mortgage process. You would talk to lenders and they would usually throw terms out at you. We're going to go over a few of those. One of the first things most home buyers ask is, what is the interest rate? And so the interest rate is what is called, it's the cost of borrowing a principal loan amount. It can be fixed or variable, but is always expressed as percentages, which is one of the first things a person always asks, because they think that's the most important part of the loan. But it is a very important part of the loan, but it is usually not the most important part. The APR is something that we usually attach to the interest rate, which is generally big nowadays for you to check what is the APR versus the interest rate that you're actually getting. So a broader measure of the cost of your mortgage, because it includes not just the interest rate, but also what's the closing cost of the mortgage. So some of the closing costs are added in there, including sometimes if you're paying points. So your the biggest spread you have between the APR and the interest rate usually can tell the amount of fees that you're being charged when you're actually closing on your mortgage. Discount points. Now, a lot of times you can actually buy your rate down. So what fees specifically used to buy down your rate is called discount points. This makes them different a little bit from origination points. Origination points are fees that are charged to you by the bank. It's usually will end up paying origination points when you have less than stellar credit. So sometimes if your credit is a little lower, a lender may charge you origination points. The discount points is used to pay your rate down a little bit. So if you end up with a 4% rate and you say, hey, I would like that 3.75, and sometimes you can pay a discount point to lower your interest rate. And then the big term that a lot of times you would hear if you're putting less than 20% down is called PMI, which is called private mortgage insurance. So it's an insurance that is placed on your mortgage when you put less than 20% down, but it does not protect you at all. It protects the lender in case of a loss, the event of the mortgage goes into default. So the lender is covered just a little bit with the loan. So there's a thing that's called private mortgage insurance, which we'll touch a little bit more on also when we go into down payments. Now, most common types of mortgages, which is generally you have what is called your fixed rate, and then you have what is called your adjustable rate. And a lot of times, as a first-time home buyer, most times when people mention adjustable rates, people tend to scramble from that because they get a little fear, and then when you hear the word adjustable. But we're going to touch on that and show you how adjustables can be good for you. So a fixed rate, we'll start there first. It's an interest rate that is constant for the duration of the loan. You know exactly what your payments is going to be each month for the life of that loan. So when you have a fixed rate, so if you, for example, if you lock in at a 4% rate, that rate stays the same if you take a 30-year mortgage. So for 30 years, you will be paying on 4%. So that's why they call it fixed, so that's not jumping around on you. If the interest rates drop, when you lock into your fixed rate, you can always refinance to get a better rate. If the interest rates happen to go up, then you'll be a little happy because you know, okay, my rate is set at a certain rate. So that's the benefit of a fixed rate. It's generally for a person who doesn't like any surprises and would like to know, okay, my mortgage payment is going to be the same every month. that's the person that generally a fixed rate is usually a better option for. Now the adjustables, which is an adjustable rate mortgage, which is we call an ARM in the industry, is your mortgage payments can change over time, and it all depends on the type of adjustable you take. The common adjustables that are available is you have what is called a 1 year, a 3 year, a 5 year, 7 year, a 10 year. And after that interest rate, it will be adjusted annually. And I'll walk you through on what the number means when we say 1, 3, 5, and 7. Now, if you look at this, the adjustable rate, the first number you have is a 5, and the second number we have is a 1. So this is called a 5-1 arm. And then the first number indicates how many years the initial rate will be set for. So the 5 indicates that your rate will be set at a certain interest rate, usually a lower rate for the first 5 years, which means your payment stays the same that first 5 years. After you get through that first 5 years, you get to that 6th year, and it tells how often your interest rate will adjust, which at that point your loan will be considered a 1-year arm. So when you get to that second term, that number, it's considered whatever the adjustment will be. Now arms often have caps, and once the interest rates can rise or fall. A common arm is the 5-1 and the 7-1, which has a cap of 2 and 6. So I'll explain to you how the caps work. So that means that the rate is fixed for 5 years, as I said, and the interest rate may reset every year after that. So the caps are basically, so let's say we get to the 6th year and that rate is going to adjust. So we start off with, for example, a 3% interest rate. So for 5 years we're paying 3%. And when we get to that 6th year, we will receive a letter letting us know if our interest rate is going up or if the interest rate is going down. So that 3% can go as high as 5%. Or it can go down as low as 1% because we have a 2% adjustment cap on there. So that's what the first 2/6 cap means. Now the 6 means over the life of that loan. Let's say you never get out of that. You take that arm and you take it for 30 years. So over the life of that loan, you have a 6% cap on there. So if we start off at 3 and you never change it, and you keep it for 30 years and the market just keeps adjusting up, the most that rate can go, you add that 6 plus the 3, the most that rate can go is 9% over the life of that loan. So that's what the 6% cap means. So it's there to protect you. And the 2% is there to protect you after that 5th year. So that 6th year, we want to make sure that 3% rate is not jumping to 10%. So it has that 2% cap to make sure the highest it will go is 5. Or this time, if the market is good, the lowest it will go is 1. And just to let you know, the rates actually predict what that rate will actually change to when you get to the end of that adjustable period. And you actually, a lot of times people will take this when they're looking to take a lower payment. So if you have a house that you really like, sometimes you get a fixed rate on there, and that fixed rate makes the payment a little bit higher. Sometimes people will look at a 5-1 or 7-1. The 7-1 is the same as the 5-1. The first 7 years it's fixed, and then after the 7th year it becomes an adjustable. So those the last slide we had when we mentioned 1, 3, 5, and 7, that's those, and 10. Those are the terms. So the first number is the fixed rate term, and the second number is the adjustable rate term. And also I want to mention that here at Great Alliance we do have a 5-5-30 adjustable, which means it's fixed for the first 5 years, and then we'll adjust the next 5 years. And so you have every 5 years you will have an adjustment period up until 30 years. It does have a 2% cap on there as well, with a maximum rate of 8.99. So it's a very good adjustable program versus the standard Fannie Mae program, which is the one we have on the screen here. Now, benefits for a fixed rate and drawbacks on a fixed rate. So one of the big things is security. We all know it's easy to predict our monthly mortgage payment over a long period of time when we have that fixed rate, which means, okay, we know our payment will be the same. You don't have to worry about it changing. Then we'll go over to what's involved in a mortgage payment. Usually when you have a fixed rate, you don't have to worry about the rate change, and sometimes the payment may change depending on the town that you buy in, if the taxes change, that type of thing. But the payment and the rate itself stays the same. So you're protected from any rate rising environment. So Drawbacks is interest rate is generally higher, so you will have a higher rate on a fixed because there's a lot of security in it, so you don't have any type of risk. So the rate is generally a little bit higher when the market is up. Like now, the market is starting to move up a little bit, and so the 30-year rate is a little bit higher. Then the rates drop down when the market, if the rates do drop down, you won't be able to take advantage of that on a fixed rate unless you decide to refinance. All right, so benefits and advantages to having adjustable. Of course, the interest rate is usually lower. Like I said, on the 5, I think right now it's somewhere around 3%, a 7, maybe 3.125. There is a chance that the rate can go down. So you can, for example, and I'll just give you a personal story. On my home, I have a 5-1 arm, and I've been in my house for 17 years. And the reason is when the market went backwards, so did my rate. So my rate started at 2.875, and we went almost down as low as 1.875. And right now I'm at 3%. And I've been in my house 17 years, so you can benefit. So when the market is going backwards as far as interest rates, you can be in that house for almost 30 years with almost 20 years with an adjustable. The drawbacks is you can experience payment shock if the rates start to move up when you get past that lock period. So if it's a 5-1 arm or 7-1 arm and the rates are moving up, you can have an adjustment in your rates, so the rates can move up on you, and so you may need to refinance if the rate starts to creep up a little bit too high on you. All right, let's talk about length of loan. So each mortgage program we have a time frame on how long you want, depending on how long you want to be in the house and the type of what your plan and goals. A big factor to consider when you're looking for your mortgage and when you're shopping is your goal and your term on how long you're going to be in there. So with most conventional mortgages, you can make you can go anywhere from a 10, 15, 20, or 30 years. So those are fixed terms. So if you have a plan, you say, okay, you know what, this is going to be a small mortgage. I want to try to pay this off in 10 or 15 years. Then those are excellent programs to actually go for. If you choose a longer term, you will end up paying more in total interest to the lender, but you will have a lower monthly payment. So if you know, okay, I can't afford a 15-year term, but I want to take a 30-year, and the rate will be a lot lower on that 30-year than it would be on a 15-year. The 15-year, you may pay a lower rate, but you will have a higher payment because your term, you're paying the payment, you're paying the mortgage off in a shorter term. So it all depends on what your goal and what your plan is. I know some people who would take a 30-year and then maybe refinance out of 5 or 10 years and say, you know what, I want to try to pay this house off a little faster. So then they would refinance into a 15 or 20-year just to try to get the house paid off. Generally, a lender probably would like to see pretty good credit scores when you're looking at the longer to the shorter term loans. So you want to have in the mid 600s or higher when you're depending on the type of loan that you're going for. But one of the big things is when you're out there shopping is you want to set a goal, and your goal is, okay, how long we plan to be in this house, what type of mortgage term we're going for. And with that goal, it will also be good when you look, okay, what type of mortgage term are we going for? Okay, but what type of mortgage should we choose? What's important to us? So remember, we said setting that goal, so planning to stay in your home for a certain period of time. So if you know this is a starter home for you, okay, this is the first home we're going to buy. We're only planning to be in here 5 years, so that's one of the things you want to do the math on. So if I'm going to be in this house 5 to 7 years, do I want to take a 30-year rate at a higher interest rate, or do I want to go for an adjustable with a 5 or 7 year term on it? Being that I'll be able to pay a lower interest rate, and that way you know, okay, you're not paying so much in interest on a 30-year fix, because one of the things you don't want to do is say, oh, this is our first house, I'm gonna lock in on a 30-year rate, and then you're paying all of this interest to the bank that you could have eliminated if you just took a shorter term on there. If I choose a quarter lower rate for an additional 1.5 points. So if you decide, okay, I want to lower this interest rate, the rate is right now on a 30-year fix 4%. Maybe if I pay a quarter, or maybe if I pay a half a point, I can drop that rate from 4% to 3.875. I'll pay 1 point and drop it to 3.75. That 1% is 1% of whatever your loan amount is. So if it's a $300,000 loan, you're looking at $3,000, and then you have to do the math and say, okay, when will I recover that $3,000 we just spent just to lower that interest rate? You also want to look, okay, if I'm lowering my rate from 4% to 3.75, what is it actually reducing the payment down to? That's another factor that you want to look at, because if I'm paying $3,000 to lower this rate, is it dropping my payment only $5? Then it's not worth doing. So those are the things that you, when you're talking to your lender, things that you want to consider if you decide you wanted to try to buy the points down a little bit. In these calculations, running these numbers and putting it together can also be very confusing, which is why this is when choosing that right lender comes into play, being able to get on the phone and going over the scenarios and the different options with your lender. That here at Great Alliance, we have the availability that you're always able to talk to us and know, okay, what are my options and what am I looking at doing as far as trying to put together your first mortgage. And so this is going to keep us on that goal section I was telling you about. So choosing that right mortgage. So know your goal. So your goal is not to get the lowest monthly payments, but to minimize the amount of interest you pay. The mortgage companies make their money off interest. So when you close on that mortgage, you'll find that first 7, maybe longer years, the majority of that mortgage payment, and we'll go over the what makes up a mortgage payment in a few minutes, is how much money are you paying back to that lender. So when you know what your goal is, you can eliminate how much money is being paid back to that lender when you set the right goal and with your right plan on making that home purchase. Your future plans, what you think about how long will you plan to stay in the home, which is big, and what I was talking to you about before is, if I'm going to be in here 5 years, this is my starter home. Then you calculate the numbers and calculate the interest that you'll pay over 30 years. You might look at the interest on how much you'll pay on a 5 or 7 year type term. The 30-year fixed rate loans are very popular, and you may want to stay in your home for 30 years, or you may plan to say, you know what, this is my first home, but this is also my last home. Then that 30-year fixed rate program might be the one for you, because you want to listen. I'm secure that I know my payment will be the same over 30 years. And just ask yourself, how long are you going to be in that new home? If it's 5 years, you should look at the adjustables, or look at not just a fixed 30-year rate. If you notice, I'm bringing up the 5-1 and 7-1. I generally don't usually put first-time home buyers in the 10-1, only because the rate on a 10-1 is so close to a 30-year fix that if you get to that point, you might as well take a 30-year fix. So a lot of times you'll find more of a benefit with the 5-1 or the 7-1. And there are some depending on some goals and some people's plans, they might take even a 3-1, which is a fix for 3 years, and adjust from there on out. Now let's talk about the type of mortgages, whether it's conventional, whether it's an FHA, that type of thing. So normally what we look for in a conventional mortgage is the credit. So a good credit is a good credit history, is a favorable loan. How much is the member putting down? Whether it's 20% equity in the property, is the property, if you put down less than 20%. Remember earlier I was talking to you about what's called private mortgage insurance, which is PMI. So it's a PMI eligible property, which means if you put down 5%, you will be paying PMI on there until you reach that 20% equity in that property. Until you reach 20% equity and have 80% loan to value. So some of the drawbacks for conventional, if you have less than stellar credit, which means conventional looks for a 620 credit score, but they really want to see anything over 680. When I say look for a 620, you would have to have some other compensating factors, which will make that a stronger loan, which will make it more favorable for a conventional program. They really want to see, 660, 680 credit scores. Less than 20% down, the home is eligible for PMI. They would prefer to see you put more down, so that way you have, it's more of, I would say, skin in the game, which means more of money that you put down into the program, into the loan that you're going for. If not eligible for PMI, cannot put at least 5% down on purchase of a home. So that means that a lot of times if you can't get the PMI, because not only do we have to approve you as a lender, we also have to get you approval from private mortgage insurance. So sometimes if you put down 5% and the mortgage insurance companies, we might say we like the loan and the mortgage insurance company is not too sure about it, then there's a chance that they will require us to have you put more down. So it's conventional financing, although it's a little bit easier to do as far as doing home inspections and that type of thing. It can be a little tough if your credit scores aren't on the range that they're looking for. Now, we're going to talk about what is called, we call in the industry PITI, but as a first-time home buyer, it's principal, interest, taxes, and insurance. So this actually is the four components that make up your mortgage payment. And there's another component that I'll talk to you about that we don't have here, but it's just in case you are looking at not just homes but condos. So principal, the amount of your payment that goes into your loan balance. So and the interest is the amount of your payment that goes to the cost of your loan. So that's how the mortgage companies make their money back on that interest part of it. So the P&I is where that's your true mortgage payment. So when you're actually looking, if it's a home for $1,000, your actual mortgage payment could be $500. So that PITI part, that PI part, could be $500. And then the next part of it is your property taxes. So when you, as a first-time home buyer, one of the important things that you're looking at, you might love the home, but then, okay, but what are the annual taxes on this property? And so if you're looking at a home where taxes are pretty common, anywhere from $6,000 to maybe $8,000, then you're probably going to end up in somewhere in the range between $400 to $500 a month in taxes. If you're looking at some areas where taxes are $12,000 a year, then you're looking at easily $1,000 for your taxes into that payment. So let's go with the lower range. Let's go with the 6 to 8. So let's say our taxes for that month is $500. So now we got the mortgage payment is $500 plus the taxes is $500, and then we have to have what is called homeowners insurance. So this is the amount of payment that goes into your homeowners insurance. So you have an annual premium. So when you're out there shopping, just like when you look for a car, before you drive off that lot, you have to have car insurance. Same thing with when you purchase your home. When you get to that closing table, we require you to have an insurance policy in place. That insurance policy you will actually go out and get. And then we'll use it and put that into your mortgage payment. So the cheaper the insurance, and you don't want to go cheap just trying to get the cheapest insurance, because you want to make sure you're covering the property in case there's any type of damage to the property. But let's say you get a policy that's $800, $900 a year, and then that breaks down into the mortgage payment also, and it's $66 a month. So you're looking at the P&I, which is $500, the taxes, which is $500, and the homeowners insurance, which is $66. So right now we're at the $1,066. And then the last thing is, if we put down less than 20%, we have what is called that private mortgage insurance. All depending on the size of the loan, could be the size of that mortgage insurance. But let's say, for argument's sake, that the mortgage insurance, and this one is $100, so we're looking at right now $1,166 as that mortgage payment. With the private mortgage insurance, or with a conventional loan, remember I said if you put 20% down, you can avoid PMI. So if you reach 80, let's say you put 5% down, but once you've been at home long enough to get your loan to value at 78% loan to value, that PMI will go away, so it will reduce that mortgage payment for you. But in this case right now, we have it in there, so we're like $1,166. We get to 78% loan to value, so that payment goes back down to $1,066. But that's so that makes up your total mortgage payment, so we call it PITI. I don't know why they call it PITI. It's a little sad because it's like they have pity on the homeowner that's closing on their mortgage and paying it for 30 years. But that's what makes up your mortgage payment. And I mentioned before about the condo. So if you're buying a condo, you have this PITI payment, but you also what we call a maintenance fee. So some condos, depending on the type of condo you're buying, whether it's a swimming pool, doorman, nice facility as far as workout facility, dry cleaners, and all of that stuff is the landscaping is nice. All of that stuff will be put into what is called that maintenance fee. So your maintenance fee, depending on how nice the building, can run anywhere from $200, sometimes $500 a month. We put that in your mortgage payment to qualify you. However, when you actually make your mortgage payment, you're making just the PITI part to us, and then you will make the maintenance fee over to your association. But I just wanted to tell you about that because we are in an area where there are some condos available, and you will sometimes run into that as a first-time home buyer. So you also have an option here at Great Alliance, what we call now. Sometimes with the conventional mortgage, they do require you to put 5% down. We do have a first-time home buyers program here. It's called a HomeReady mortgage, and it's just help that first-time home buyer who doesn't quite have 5% or have 5%. They're looking to try to have some type of cushion when they close on their first home. So with this first-time home buyers program, you can put as low as 3% down. You do not have to be a first-time home buyer, but you cannot own a home at the time of closing. So you would have to not have any mortgages in your name at the time of closing. It is counted. There does have mortgage insurance on it because it is a 3% down loan. However, the premium is a little bit lower than it would be if for a standard conventional 5% down, because it is an affordable loan program. It is the PMI on it is reduced to make sure that to try to give you a lower payment to help that member qualify for their first home. The great thing about the program is it can't be a 100% gift or grant program, which means a lot of times when you're going for a conventional loan, that 5% down payment has to come from you as a borrower. With this program, you can actually get a gift from a relative who will give you that 3% down, and you can use that as your down payment, or you can get a grant. With a grant, some first-time homebuyer grants in Bergen County and Passaic County, and the surrounding counties, well, they usually have grants for people who are looking to buy their first home, and you can actually use that as your down payment or community second. You can use cash on hands; it's permitted. You also want to make sure you source it, though. You want to be careful with the cash on hands. We have ways that you have to structure it to put it in there. A lot of times, what people do is they have cash on hand because they sometimes, depending on some clubs that people may have, where there's a cash club where they can receive a cash payout over a month, and then they would use that what's called cash on hand, and we just would track it and source it that way. The non-traditional credit is allowed. So what that means is sometimes everyone doesn't have what is called a credit score, but they may have a cell phone or they may pay car insurance, and so a lot of times we would get letters from those sources and attach that to your credit report to show that you do make a monthly payment on time to someone. So that's what the program is really. It's an affordable program to help with 3% down and to help that first-time home buyer to buy their first home. So you can buy 3% down and add gift the grants with this and try to make it to where when you close on your first home, you can have some money available after the closing. And one of the big programs we just rolled out here at Great Alliance is our Home Buyer Savings Program, which is to help you with that big purchase that you would make and help you save and save and give you $1,000 towards your closing costs. So the way the program works is actually, so you would start off, you would sign up with our Green Path Home Buyer Counseling and Education Program. Then these programs are great for first-time home buyers because it actually helps you understand what goes into just to buying that first home. So a lot of times when people are making a rent payment of $1,500-$1,600 a month, they say, "Well, I'm paying enough. I should be able to buy a house." And then a lot of times when we sit down with you, we go over what it takes to get qualified for that mortgage. When you're doing home buying counseling and education, they're going into the details of the mortgage, not just what we're not looking at. For example, dry cleaning bill, grocery bill. How much is it going to cost you to fix your car if something goes wrong? So all of that stuff is built into your home buyer's education. And so it's helping you along the way understand not just I need to make a mortgage payment plus still pay my monthly debts, but I still need to be able to live. We want you to get that first house and enjoy it, but we also want you to be able to still enjoy life, still be able to go on vacation and stuff. So with these counseling and education programs and courses, they help you understand that portion of buying your first home. Now, the next step with the program is you want to get qualified for your mortgage with us here at Great Alliance. And what qualifying does is it actually helps you understand, okay, what is going to be my mortgage payment? A lot of times as a first-time home buyer, when you're looking at homes, you may look at homes, it's a beautiful home, I love it, 2.5 bath, 2-car garage, and then you don't realize what the payment's going to be on there. Getting qualified helps you stay in that range of where you want to be. Okay, I know I spoke to my lender. My lender told me I qualify for $200,000, $300,000. $300,000 may come with a mortgage payment, $2,400, maybe $2,500 a month. That's the most I want to pay. And let's say we want to go a little lower. I make right now my rent payment is $1,700. The most I want to pay on a mortgage is $2,000. So when we qualify you, you may qualify for that $300,000 home, but you said, okay, the most I want to make a mortgage payment is $2,000. Then we know it's nice to know we qualify $300,000, but then let's reduce that pre-qualification letter that we're going to give you down to a range that's going to keep that payment around $2,000 for you. So it helps you structure and helps you stay on point as far as what you're looking at as a first-time home buyer. Also, one of the first things a real estate agent is going to ask you when you actually start shopping for your home is, I need to see your pre-qualification letter. And what that letter is the letter that we provide you So that real estate agent can start taking you out. That shows a realtor that you're really serious about purchasing that home. And it also gives that realtor a range on what they should start pulling up on the MLS for you. So when you give them that letter for 250 or 300,000, they could pull up in the MLS the homes that you told them that you're interested in that price range to kind of keep you on target on what you're looking for as far as that mortgage payment. So the third option, so you have, which is the home buyer savings program that I just mentioned to you, where you can earn anywhere to 0.15 APY and save a minimum of $100 a month. So now with this program, it's a great savings program because you come in to the branch, open up your account. You would put in there $100 a month for 12 months. Now you must deposit the funds into the savings account. Now you also have to make sure it's being directly deposited in there. There's no minimum balance fee, but and no credit report required. No fee for and there's no fee when we qualify you for mortgage. So as a member, you're getting qualified for your mortgage, and we're not charging you for that. You only allow one withdrawal out of the savings account. So we don't want it to be an account where you go in, you deposit, and you're building up your $100 a month, and then you decide you're going to take money from there. So we want to make sure it's something that's going to help and benefit you when you get to the time when you're looking to buy that house. So we want to limit it to only one withdrawal. And there's a lot more information that we'll get on the program once we're off the call. If you want more information, you feel free to give us a call. With this program, though, you will receive $1,000 towards your closing costs with your Great Alliance mortgage. So remember, we were talking 3% down. If you have a gift or grant, we get your grant program plus this program, which is $1,000 towards your closing costs. So we're trying to make it to where less money is taken out of your pocket towards the purchase of your first home, and we're trying to give you as many different programs and options to get additional money to help you purchase that first home. And there's another big program I'm going to tell you about before we get off the webinar here. Now, conventional mortgages goes up to what happens in region, we call it conventional. They have a max loan amount that you can go to, which is $428. So anything that's over $428 is considered to be a jumbo mortgage. So anything under $428 is called a conventional mortgage. So that's we call it the conventional world. So if you go out and you see a house that you love and it's $500,000, now you're considered to be a jumbo mortgage. Plus size homes when in a dollar amount above the conforming limit. So the conforming loan limit is at $428. Typically it comes with a more demanding requirement. So the down payment is usually a little bit higher than the conforming loan. The jumbo loan may be right for you if you have lower debt to income. So the reason we say that is because that mortgage payment, once you start reaching anything $500,000, $600,000, the mortgage payment can be really, really hefty. So the lower your monthly debt is, and to make that affordable, the better. Here at Great Alliance, we offer anything over that conforming limit, $479, up to $1 million. So if you saw a beautiful home that you love and you qualify for that $1 million loan, then we at Great Alliance can actually we have the program options and program available to help you with that. Generally, you will not have PMI on a jumbo loan because usually the person that's looking in that type of price range usually has the assets in order to put enough down to avoid PMI. So so it's a different type of world once you get past that conforming loan limit to go into the jumbo range. Usually you're looking at bigger homes, bigger tax payments, and bigger monthly mortgage payments. So the down payment is generally a little bit bigger with the jumbo mortgage. Now, this is the other program I was telling you about. So along with the $1,000 Savings Club program that we also have for a limited time only. So for a purchase mortgage within a certain within a certain time period. So if you close on your home before June 31st, if you purchase your home before June 31st and close before September 31st, we will give you a $500 Visa gift card at closing. So there's no application fee, no rate lock-in fee, fixed or adjustable rates available. So you can apply for that mortgage between June 31st and close before September 31st and take advantage of this offer. So remember, we have the $1,000 Savings Club program, we have the $500 gift program, and then we also have 3% down program that are making it really affordable for you to purchase that first home. And all you have to do is really give us a call if you're interested in taking advantage of this. This is a limited time offer, so it is a small window. We're in May now, so you got June 31st, 2018, and you need to close by September 31st, 2018 to take advantage of this unbelievable offer that we're offering here at Great Alliance. Now, I also want to take the time, we also have, and this is our webinar series, we want to say, month that's here. And so we have a few other great webinars that are coming up. I have a colleague, Patrick Faulkner, who will be doing some of these webinars. He actually did one last week with us. The next one that's coming up is May 16th, which we'll be going over with is down payment options, 20% down versus the PMI, that private mortgage insurance I was talking to you about. Also on the 23rd, we're going to go over the buying process and the closing process. And then the last one for now, but we will have other webinars coming up, is on the 30th. We will have renting versus buying. And this is the time we can ask any questions. Okay. So here are some of the questions that we have. In this rising rate environment, would you recommend going for an ARM or a fixed? So that's a great question. I would recommend that depending on what you're looking at as far as your mortgage payment, when the rates are starting to creep up like they are, it does make it a little bit more affordable to go for a adjustable. And when I say adjustable, I would always tend to put that first time home buyer in the category of the 5-1 or the 7-1 adjustable, just to make that mortgage payment a little more affordable. And also with the adjustable, it also helps you if you're coming from renting and you want to just get adjusted to making mortgage payments. It kind of keeps your payment a little lower than it would as a fix, and kind of gives you that adjustment period to 5 years or to 7 years to get adjusted to making mortgage payments and being in that lower payment option rather than just going right into a 30-year fix. So with that question, I would, with the rates rising the way they are, I would look at that option, especially if you, once you get qualified and you go out there and look at homes, and depending on the taxes and the variables that go into that mortgage payment, if that payment seems like it's going to be a little bit too much at a fixed rate, don't be shy to say, hey, what's my adjustable rate option on that? And it will give you the numbers on a 5-1 and 7-1, and you'll see it may drop that payment anywhere $200 to $300 down compared to what it would be on a fixed rate. Next question. The discount points help me lower my interest rate. Yes, they do. So they would, and that's one of the things you want to look at as far as your goal and what we spoke about earlier. So if you're looking at a 30-year fix and the rate is, let's say, 4%, and you pay a half a point discount. So depending on the loan size, will that drop your rate down from 4% to 3.875 or 3.75? How low will it drop my rate if I pay the discount point? I spoke to you earlier about if it's let's say if it's 1% and it's dropping you from 4% to 3.75, and it's a $300,000 loan, that's $3,000, and then you want to look at the numbers. And is my payment dropping down $20? Okay, how long will it take me to recoup that $3,000 I just spent? So that's one of the things when you're sitting down to get qualified and going over the options is we want to look at that. If I pay the discount point, will it drop that payment down enough for me? Or is it better off if I just kept that $3,000 in my pocket to have that closing cushion, or to have money if I want to put new furnishing to the apartment, to my house when I move into it? Next question. How long does it take to get approved for a mortgage? Well, that's a very good question also, but it also depends on how fast you're looking to move. We've been known to close loans in about 22 days. So what happens is we're an e-sign company, so it means that all the disclosures and stuff we send to you once we get a contract is sent to you by email, and then you would turn around and e-sign and get that information back to us. Then my processor will turn around and ask you for your disclosure. So it depends on how fast you get us back documentation. Once we get a contract and everything on you and get your disclosure signed by you, we're ordering an appraiser to try to get that appraiser out to the property. That can be the thing that slows it down the most, because sometimes it can take, depending on how busy we are, the appraiser 2 weeks to get out there to appraise the property. And then if you are, let's say, slow on sending your paperwork back, that can also delay it. And so when I say slow on sending paperwork back, they'll send you a list of the items that you need to send back. And a lot of times they'll ask for tax returns, W-2s, pay stubs, bank statements. And so the big hang-up is sometimes members don't send back exactly what they need in order to move along forward. So if they're asking you for your bank statements and you receive five pages in the bank statement, send all 5 pages, even if that 5th one is blank, because that if you send 4 and they're looking and it says on the top of the bank statement 1 of 5, that process is looking for that 5th page, even if there's nothing on it, and that can actually hold you up 3 or 4 or 5 days just trying to get that 1 page in. You'll as a member say, hey, I sent you your information, and she's saying, oh no, I'm still missing 1 page. And so that type of stuff you want to make sure you follow exactly when they send you a list on what to send back. Send back what they need, and the process can be a lot sooner. You can do it less than 30 days these days. Do you finance condos? Yes, we do. That's a very good question. We actually, and that's one of the things I mentioned with that maintenance fee in there. So yes, we do on conventional, and with the 3% down program, you can actually do a condo. And when you're out there, for that person who asked that question, one of the things you want, when you're looking at the condos, you can find out what the maintenance fee is when you're going out and look at the condo. So that's one of the things you, as a shopper, want to put into that mortgage payment when you're trying to figure out how much was my payment going to be, is how much is that maintenance fee going to be. Like I said, the prettier the condo, the doorman, swimming pool, health club, usually all that stuff is built into that maintenance fee because that's what helps maintain the condo and make it look as nice as it looks. Next question I have, what is the most you can make to qualify for a HomeReady program? So the HomeReady program, that's a good question also because it is income driven, but it's income driven according to the area that you're in. So there's a map that we will put you into, and it all depends on the actual area and how much they're looking to increase home ownership in that area. So for example, I'll say Patterson, for example. You can make over $100,000 in Patterson and qualify for the HomeReady program. Now, if we turn around and go to, let's say, Bergen County and Paramus, it may be your limit is at 87 or 97,000 is the most you can make for that program. So when we're qualifying you, we would actually know what range or what area that we're looking to buy in, and so that's and we'll look into that HomeReady program with that. But the majority of the time, it's looking where they're trying to increase home ownership, and so that's where they would normally have what is called a affordable mortgage chart. And it would tell us how much we can go as far as a loan limit in that area. And so we will do that with you when we're qualified for the HomeReady program. Oh, we have a few more questions that came over. Can I buy homes anywhere with the HomeReady program? Yes, you can. It's a program throughout the state of New Jersey and actually New York. So you can buy a home anywhere with the 3% down program. Like I said, it all depends on where you're buying at. We will look, the program does have a map, and it tells us on that map once we punch in the area that you're looking to buy in, it gives us how much we can the loan limit that we're looking to buy in that area. But you can use that program in anywhere in the state. And the next question, do I just call if I qualify for the HomeReady program? Do I just call if I qualify for the HomeReady program? Yes, you can just, with all of the programs that we went over, just give us a call and we'll go over the program options. And with the HomeReady program, you'll tell us what you're looking to do as a first-time home buyer. If you know, even if you have 5% down, we want to try to structure it to where we can make it as affordable as possible for you to buy that first home. So a lot of times we look and that person will come to us and they say, I have this amount of money to spend. We help them structure that with 3% down, help them structure it with the gifts and the grants, because our goal is to get you in that first house, but also to make sure you have money left over in the bank, just to make sure you're comfortable as that first-time home buyer. Because with that program and with any first-time home buyers program, when you're coming from renting, a lot of times if something goes wrong when you're renting, you just call up your landlord, whether it's the hot water's leaking or the washing machine's not working. Your landlord's responsible for fixing that type of thing. But you as a first-time home buyer, when you close in that house, you're the landlord now. So we want to make sure that you're as comfortable as possible and have enough assets left over that's going to make you comfortable as possible when you're in that house. Oh, the questions keep coming through. One more question just came through. If I have 50% down, will I have to get PMI? Yes, you do. With 15% down, you will have a 5% portion on there. The PMI will be a lot lower than it would be if you put 5% down, but because it is still less than 20% down, you will still have PMI on it, but it will be a smaller premium, and it will come off a lot faster because you put 15% down. Yeah. Oh, that's it for the questions. Oh, very good questions, and I thank you all for jumping on the webinar, and thank you all for attending. I'll turn it back over to Brian.
Yeah. So thanks again for attending. I hope you got a lot of value out of this. I just want to let you know that if you can like us on Facebook at facebook.com/GAFCU, or you can follow us on Twitter at Greater Way to Bank, and we also have a lot of fun YouTube videos if you want to check us out there. Again, we're going to have this webinar. It's going to be recorded and sent to your email. So if you miss something or you want to send it to someone, you're going to have that in your email. It should arrive in the next hour or so, so keep an eye out for that. And again, make sure you register for our next webinar on May 16th. We'll go over down payment options, 20% versus PMI. You should get a lot of value out of that as well. If you want to register for that, just go to www.greateralliance.org/webinars. So again, if you have any questions, you can give us a call or email us at any time. And again, thank you for attending, and have a great rest of the day.
Thank you.
Thank you.